direction. For the past few years, the U.S. economy has been on a roll. Unemployment has been low, wages have been rising, and businesses have been booming. It's been a period of sustained growth, fueled by consumer confidence and a strong job market. But beneath the surface, cracks have begun to appear. Inflation, the silent thief of our wallets, has started to rear its ugly head. Prices for everyday goods and services are creeping upward, eroding the purchasing power of consumers. The cost of living is rising faster than wages for many Americans, putting a strain on household budgets. Adding to the uncertainty is the global economic outlook. Trade wars and slowing growth in other parts of the world are casting a shadow over the U.S. economy. Businesses are becoming more cautious, and consumers are tightening their belts. These are the challenges that Jerome Powell faces as he steers the Fed. It's a delicate balancing act, and his decision to cut interest rates is an attempt to thread the needle between supporting growth and keeping inflation in check. Time will tell. Manufacturing and business investment have slowed. Consumer spending shows resilience, but also fragility. Every word Powell utters is dissected for clues about the Fed's next Adding to the economic uncertainty swirling around the globe is the ongoing trade war between the United States and A key role in boosting consumer confidence. When mortgages, car loans, and credit card debt become less expensive to service, consumers have more disposable income to spend or save. This can provide a much-needed boost to household budgets, making people feel more financially secure and optimistic about the future. Furthermore, lower interest rates can encourage consumers to make big-ticket purchases they might have otherwise delayed, such as buying a new home or car. These purchases can have a significant ripple effect throughout the economy, boosting demand in various sectors. However, consumer confidence is a fickle thing, easily swayed by economic uncertainty, political events, and even the weather. While lower interest rates can provide a tailwind for consumer spending, it's just one piece of a complex puzzle. The housing market is a cornerstone of the U.S. economy, and its health is closely tied to overall economic growth. When interest rates are low, mortgages become more affordable, making it easier for people to buy homes. This increased demand can lead to a rise in home prices, which can boost construction activity, create jobs, and generate a positive wealth effect for homeowners. Lower interest rates can also make it more attractive for existing homeowners to refinance their mortgages, potentially lowering their monthly payments and freeing up cash flow for other expenses. This can provide a welcome financial cushion for families and further stimulate the economy. A healthy housing market is a boon to the broader economy, as it creates jobs not just in construction, but also in related industries like real estate, finance, and manufacturing. When people buy homes, they tend to spend money on furniture, appliances, and renovations, further boosting economic activity. However, it's important to note that the relationship between interest rates and the housing market is complex, and other factors, such as inventory levels, affordability, and consumer confidence, also play a role. The stock market, often seen as a barometer of economic sentiment, tends to react favorably to interest rate cuts, at least in the short term. Lower interest rates can make stocks more attractive to investors compared to other asset classes, such as bonds, which typically offer lower returns. When the Fed cuts interest rates, it signals that it's willing to support economic growth, even if it means taking a more accommodative stance on monetary policy. This can boost investor confidence, leading them to pour money into the stock market, driving up stock prices. However, it's important to remember that the stock market is not the economy, and its performance doesn't always reflect the underlying economic fundamentals. While lower interest rates can provide a short-term sugar rush for the stock market, the long-term impact is less certain and depends on a multitude of factors. Furthermore, if the rate cut is seen as a sign that the Fed is concerned about the economy, it could actually prices they're used to. Imagine your morning coffee going up by a few cents every week, then your groceries, then your rent. Suddenly, your paycheck doesn't stretch as far as it used to. The Fed aims to keep inflation around a manageable 2% target, but lower interest rates can make it harder to keep the beast at bay. When money is cheap to borrow, consumers and businesses alike tend to spend more freely, increasing demand for goods and services. If supply can't keep up, prices rise and inflation sets in. This is the delicate tightrope the Fed must walk, stimulating growth without letting inflation spiral out of control. It's a constant game of economic chess, with Powell and the Fed making strategic moves based on a complex and ever-changing economic landscape. While lower interest rates might sound like good news for borrowers, they can be a real downer for savers. Imagine diligently putting money aside each month, hoping to earn a little extra through interest. Now imagine those interest rates dwindling to almost nothing. This is the reality for many Americans in a low interest rate environment. Those who rely on interest income from savings accounts, certificates of deposit, and other fixed income investments see their returns dwindle, making it harder to build a nest egg or plan for retirement. Low interest rates can also discourage saving in general. When the return on savings is negligible, it can be tempting to spend money now rather than put it aside for a future that seems less financially rewarding. This can have long-term consequences for both individuals and the economy as a whole. A strong savings rate is essential for funding investments, fueling innovation, and ensuring long-term economic stability. When savings rates decline, it can create a drag on future economic growth. One of the potential risks of a prolonged period of low interest rates is the formation of asset bubbles. When money is cheap and readily available, investors often chase higher returns, pouring money into stocks, real estate, and other assets, driving up prices beyond sustainable levels. This can create a dangerous illusion of prosperity, as asset prices become disconnected from their underlying value. Investors, caught up in the frenzy, may take on excessive risk, believing that the good times will never end. History is littered with examples of asset bubbles inflating and then bursting with devastating consequences. The dot-com bubble of the late 1990s and the housing bubble of the mid-2000s are stark reminders of what can happen when exuberance trumps prudence and asset prices become untethered from reality. The Fed is acutely aware of the risk of asset bubbles, and it's one of the factors we can better navigate the future. No exploration of interest rate history would be complete without revisiting the Volcker shock, a pivotal moment that left an indelible mark on the U.S. economy. In the late 1970s, the U.S. faced stagnant growth and soaring inflation, known as stagflation. Paul Volcker, appointed Fed chairman in 1979, took a radical approach. He aggressively raised interest rates to combat inflation. The federal funds rate soared to 20% in 1981. The U.S. economy plunged into a deep recession, with unemployment soaring. It was a painful period, but Volcker's measures proved effective. By the mid-1980s, inflation was tamed, and the economy grew robustly. The Volcker shock highlights the importance of tough decisions for long-term stability. Alan of 2008, triggered by the collapse of the U.S. housing market, was a stark reminder of the interconnectedness of the global economy. The Federal Reserve, under Ben Bernanke, faced an unprecedented challenge. They slashed interest rates to near zero and implemented quantitative easing. These measures are credited with preventing a second Great Depression. The U.S. economy experienced its deepest recession since the 1930s. Millions of jobs were lost and homes foreclosed. Janet Yellen oversaw a gradual process of raising interest rates. The Great Recession highlights the importance of adaptability in monetary policy. Jerome Powell, facing his own set of economic challenges in 2024, has the benefit of hindsight, but that doesn't make his job any easier. The ghosts of past interest rate decisions loom large, offering both guidance and cautionary tales. From the Volcker shock, Powell can learn the importance of a strong and independent central bank willing to make tough decisions, even if they are unpopular in the short term. The Greenspan era highlights the dangers of complacency and the unintended consequences of prolonged periods of low interest rates. The Great Recession and its aftermath underscore the need for adaptability, innovation, and a willingness to use all available tools to prevent economic catastrophe. But perhaps the most important lesson of all is that history rarely repeats itself exactly. Each economic cycle presents its own unique set of challenges and opportunities. The global economy is constantly evolving, shaped by technological advancements, geopolitical shifts, and demographic trends. Powell must chart his own course, drawing on the lessons of the past while remaining vigilant and adaptable in the face of an uncertain future. The stakes are high, and the world is watching. Jerome Powell's decision to cut interest rates has ignited a firestorm of debate, splitting economists, analysts, and everyday Americans into camps of cautious optimism and wary skepticism. Like a coin tossed into the air, the outcome hangs in the balance, with the potential for both positive and negative consequences. Proponents argue it was necessary to prevent the U.S. economy from slowing down. Critics warn it's a dangerous gamble with long-term consequences. The truth likely lies somewhere in the middle. The impact will depend on a complex interplay of factors. Business investment has been sluggish and global growth has weakened. The trade war with China, though showing signs of a potential truce, continues to cast a shadow over the global economy.